Welcome to the deep dive. Today, we're really digging into something interesting happening in the mobile crypto space. We're focusing on the Pi network. And honestly, the source material paints this picture of real tension. You've got charts kind of screaming caution, but then the underlying tech seems like it's on the verge of a pretty major breakthrough. It's this moment where, as one analysis described it, you see technical correction meets fundamental progress.
Exactly. And our mission here, for you listening, is to really pull apart that conflict. We need to look beyond the current price, which, yeah, is sort of bouncing around $1.26. We need to understand what the, let's say, smart money might be doing. The idea isn't just to, read the tea leaves of the technical charts. It's to connect that short-term noise, that volatility, to the big structural shifts happening underneath, especially these key tech milestones that everyone's watching for in Q4 2025.
Right, that $26 level, it's basically where things have settled after that drop we saw back in September. So, okay, let's start where a lot of cautious folks would start. The immediate technical view. What are those charts telling us right now?
Well, if you're looking just through that technical lens, the immediate picture does suggest being careful. The daily chart is showing what analysts are calling a bearish flag pattern.
Okay, bearish flag.
Yeah.
For people maybe not deep in trading jargon, what does that pattern actually look like and why is it a warning sign?
Sure. Think of it like this. You have a sharp drop in price, that's the flagpole. Then you get a little period of trading mostly sideways, maybe drifting slightly up. That's the flag itself. It basically suggests the market's just taking a breather, not necessarily reversing course. And typically what happens next is the price continues downwards, resuming the original trend. So yeah, traders see that and get understandably cautious. It signals we might not have quite hit the bottom yet.
Okay, so that's a technical headwind. Given that, where are the really critical price levels market's testing? And importantly, where does it need to break through to maybe signal a real recovery?
So we need to watch a couple of key lines on the chart. And what's actually quite fascinating here is, despite that bearish flag pattern, there's a crucial support level down at $0.25. And the reports say it's holding. Holding quite strongly, actually. That tells you there's real buying interest stepping in whenever the price gets near that $0.25 mark. It's kind of the battle line right now.
Okay, a strong floor at 0.25 cents. If that holds, what are the ceilings it needs to break through? What are the resistance levels?
Right. For recovery, we look towards what are called exponential moving averages, or EMAs. These basically track the average price over a set period, giving more weight to recent prices. The first significant hurdle, the first resistance, is the EMA 50. That's sitting up at 0.3966 right now. Breaking convincingly above that would be the first sign that short-term momentum might be shifting back upwards.
Even all 39 cents. That's a decent jump from 26 cents. What about the main resistance, the bigger hurdle?
The main one analysts are watching is the EMA 100, which is further up at 0.482 ounces. But even before that, for the project to really confirm a structural reversal, to negate that bearish flag signal, the source material suggests it needs to break clearly above the immediate resistance around $0.32. Think of $0.32 as like the confirmation line for traders who are waiting for proof before jumping back in.
Got it. And just briefly, what's causing this supply pressure, keeping the price down near $0.26? It's not just the chart patterns, is it?
No, definitely not. There are concrete factors at play. The analysis points to ongoing token unlocks. These are tokens being released, perhaps to early miners or project stakeholders. That naturally increases the amount of tokens available to be sold, creating some temporary selling pressure. And you combine that with just a generally cautious mood across the whole crypto market right now. Well, it creates this sort of environment where the price tends to consolidate until there's a big reason, a catalyst, for it to move decisively.
Okay, so that covers the short-term caution. Now let's pivot, because this is where the story gets really compelling. If the technicals look a bit shaky and the charts are bearish, who's actually buying at these levels? And this leads to a signal of, well, massive long-term confidence that seems to fly in the face of the price action. We're talking about record outflows of tokens from centralized exchanges, CEXs.
Yes, this is probably the strongest countersignal mentioned in the analysis. It's quite striking. We saw huge numbers. 17.5 million tokens left all exchanges combined in a pretty short time frame. But what's really telling is the concentration. Get this. 15.7 million of those tokens came off just one exchange, OKX, in a single 24-hour period. That's not your average user moving a few tokens around. That's significant movement.
Right. So for our listeners, explain why crypto leaving an exchange like OKX is generally seen as such a positive, bullish signal. What's the thinking there?
Okay. So when large amounts of tokens move off a centralized exchange, and into private wallets, often called cold storage, it signals a few things. Primarily, it suggests the owners are planning to hold those tokens for the long term. They're taking them out of the readily available trading supply. They're essentially locking them away, reducing the immediate sell pressure on the exchanges. They're saying, we're not interested in selling based on short-term price swings. We believe in the long-term potential.
So the interpretation of the analysis is that this points towards rising institutional confidence, or maybe whale accumulation, as they sometimes call it. Basically, big players stepping in right around that key 75% support level we talked about.
Precisely. It looks like strategic money is buying into the fear. While the charts might look a bit scary to some, these perhaps more informed, larger players seem to be taking advantage of the lower prices. They're systematically accumulating, likely because they trust the fundamental value and the future roadmap more than the immediate technical pattern. They're betting on what's coming next.
And that roadmap brings us neatly to the next major point, arguably the biggest fundamental milestone validating that kind of confidence. That's the successful launch of the decentralized exchange, the DEX, and the automated market maker, the AMM, on the project's testnet.
Yes, this is highlighted as the most critical development in the source material. A successful testnet launch essentially proves they've built the core infrastructure for their own internal financial system. We're not just talking about a simple swap function. This is described as a fully functional DEX. It includes things like native liquidity pools, AMM protocols that can support yield farming, token swapping with minimal fees, apparently, and opportunities for users to earn through liquidity mining. It's a whole ecosystem.
We hear those terms DEX, AMM thrown around a lot. Can you break down how this specifically benefits the average Pi user? What's the practical advantage for them?
Yeah, good question. The big advantage is control and, crucially, utility for the Pi token itself. The AMM, the automated market maker, is key because it removes the need for a traditional order book or middleman for trades. It lets the community, potentially millions of users, provide the liquidity themselves by pooling their Pi tokens. And in return for providing that liquidity, they can earn rewards like a share of the trading fees or extra tokens through liquidity mining. So it transforms the project from just something you mine on your phone into, well, a financial operating system where the token has immediate, practical, and potentially profitable use cases within its own network.
And strategically, why is building their own DeFi ecosystem seen as such a big deal compared to, say, just getting listed on Binance or another big CEX?
Oh, it's huge. It gives the project fundamental independence. Remember those CEX outflows we discussed? If the main place people trade and use Pi is within its own ecosystem, using Pi as the base currency for everything, then the project becomes much less vulnerable to the whims of external exchanges, listing decisions, delisting risks, trading halts, you name it. They're essentially building their own self-sustaining economy. And really strengthens the token's long-term value proposition.
And the timing here is critical, right? This successful testnet proves the tech is ready. And the expectation, according to the sources, is that the mainnet launch for this Decilium system is slated for Q4 2025, which gives those big buyers, those whales accumulating now, a pretty clear timeline for their investment thesis to potentially play out.
Absolutely. So, okay, let's maybe zoom out a bit from the immediate news and look deeper at the core strengths the analysis points to for long-term growth. We can kind of break this down into three main pillars that support the project's foundation.
All right, lay out pillar one for us.
Pillar one, the community. And this is really its defining feature. The scale is just massive. The network claims over 50 million registered users. Millions are described as daily active users, and it has this incredible global reach, something like 230 plus countries. The key driver behind this scale is that mobile-first approach. It essentially lowered the barrier to entry for crypto mining down to almost zero. Anyone with a smartphone could participate, which is radically different from traditional crypto mining setups.
Okay, I have to push back slightly here, maybe play devil's advocate, which I think the source material kind of nods to as well. In crypto, we know registered users doesn't always translate directly to active, valuable users, right? Is the source clear on how many of those 50 million are, say, you verified through KYC, your customer, or how many are genuinely poised to jump into this new DEX? That difference feels pretty significant for valuing the network effect.
That's a really critical question, and you're right to raise it. The analysis does seem to address this by trying to distinguish between just a massive list of names and an engaged community. While exact, real-time KYC numbers can fluctuate and aren't always public. The analysis points to the consistently high number of daily active users as evidence. And also the network's proven ability in the past to mobilize large parts of that user base for things like P2P transactions testing or beta programs. This suggests a level of engagement that goes beyond just, ghost accounts. They seem to be building on a genuinely active base, even if the precise KYC number isn't nailed down.
Okay, that makes sense. And it leads directly into the second pillar then. If the community is large and reasonably active, what are they actually doing with Pi?
Right, so Pillar 2 is real utility and adoption. This is where the project tries to differentiate itself from purely speculative coins. The analysis highlights the growth of the Pi apps ecosystem. Think of it like an app store built on the Pi network. It mentions dozens of applications already integrated. There's also evidence cited of growth in their P2P marketplace, where people are actually using Pi to buy and sell goods and services amongst themselves. Plus, reports of real business partnerships emerging, with local merchants starting to accept Pi, particularly in certain regions. So the argument is that utility is already being demonstrated even before the mainnet DEX launch, which helps de-risk the whole thing.
Okay, community scale, growing utility. What's at the third pillar? Let's talk about the token itself, the economics. How is it structured to support this huge community without just inflating into oblivion?
That's Pillar 3, the sustainable economic model. The analysis uses the term defensive tokenomics, which is interesting. Firstly, the mining mechanism is designed to be energy efficient. As we said, no expensive hardware needed, just a smartphone check-in. This promotes fair distribution from the start. Secondly, and this is crucial for long-term value, they use a halving mechanism, and they have a controlled schedule for releasing tokens.
Can you explain that quickly? How is that defensive?
Sure. A halving mechanism means that the rate at which new Pi tokens are created is periodically cut in half. Bitcoin does this famously. This introduces scarcity over time. By automatically slowing down the creation of new supply according to a predictable schedule, the project aims to prevent runaway inflation that could devalue the token. So controlling the supply release like this provides a kind of natural built-in support for the price, making the tokenomics potentially more stable than projects with, say, an infinite or unpredictable supply.
That makes sense. And as we sort of shift towards the strategic outlook, it's maybe worth remembering the project's origins, which the source touches on. Started by Stanford PhDs back in 2019, right? With this specific goal of making crypto accessible via smartphones to drive mass adoption, that academic background and that clear long-term vision probably adds a layer of credibility, especially for those institutional types looking at it now.
Absolutely. It suggests a certain level of, let's say, engineering rigor and long-term planning. It likely gives confidence in their ability to actually deliver on complex things like this whole integrated DeFi ecosystem. So, okay, when you put it all together, you've got the technical caution on the charts, but then record institutional buying, plus this nearly ready DeFi system. How does the analysis suggest investors or users should approach the situation in Q4 2025?
Well, the source material seems pretty direct about it. It doesn't see the current price level around $0.26 as a sign of failure. Instead, it frames it as a strategic accumulation zone, almost like a discount window opening up for the next big phase.
Yeah, and the analysis even offers some specific strategies for potentially capitalizing on this period. It defines a broad value accumulation zone roughly between $0.20 and $0.28. And for a more conservative approach, it recommends DCA dollar cost averaging.
Right, DCA. Which, simply put, means instead of trying to time the exact bottom and buying all at once, you spread your purchases out over time, maybe buying smaller amounts regularly within that $0.24 to 28 cents range. It averages out your entry price and reduces the risk of buying right before another dip.
Exactly. And the strategy pairs DCA with holding those purchases, looking towards that major catalyst, the mainnet DEX launch. The idea is to minimize the downside risk from short-term volatility while making sure you're positioned to benefit if or when those technological breakthroughs drive the price higher.
Speaking of higher prices, what are the potential upside targets mentioned, especially if that mainnet DX does launch successfully in Q4 2025?
The bullish targets are pretty ambitious, and they seem entirely linked to the combination of the huge community size and the new utility from the DTEX. The first target mentioned, maybe driven by technical recovery and initial optimism, is in the $35 to 40 cents range. Now, if the DTEX launch goes smoothly and attracts significant liquidity from the user base, the analysis suggests targets could move towards the $0.50 to 65 cents area. And then the really optimistic scenario, which likely depends on widespread adoption of the DeFi services by that massive community, pushes potential targets up towards $0.80, maybe even higher.
So wrapping up the long-term view, the core attraction seems to boil down to two main things. One, that undeniable first-mover advantage they have in making blockchain participation super accessible via mobile. And two, the potential to evolve from just a mobile mining app into this enormous self-contained DeFi hub designed specifically for potentially billions of mobile-first users globally.
Yeah, connecting all the threads, the main synthesis here seems to be this. That technical correction we're seeing. It's probably a necessary, maybe even healthy, shakeout. It pushes out the short-term speculators and creates entry points for those with a longer-term view focused on the fundamentals. And crucially, that correction seems to be happening while the underlying fundamental progress, the technology, the utility, is actually accelerating and hitting key milestones.
That feels like a solid distillation of the knowledge. So let's quickly recap the four key positive takeaways listeners should really hold on to from this deep dive.
Okay. First, those record outflows from exchanges. It's a strong signal that serious long-term money is accumulating despite the negative chart patterns. Second, the DAI-DEX in AM and tech is proven functional on the testnet. The technology is mature and seemingly ready for mainnet launch soon. Third, they still possess arguably the largest engaged blockchain community in the world, a massive user base ready to potentially adopt the new DeFi system. And fourth, that technical support level at $0.25 is holding firm so far, providing a solid base, both technically and psychologically.
That's the data, the analysis. But here's the final provocative thought we want to leave you mulling over. Given that the analysis hammers home the sheer scale of this community, 50 million plus registered users, and the imminent launch of its own DeFi ecosystem, the fundamental question really seems to shift, doesn't it? We're kind of past the point of asking if the technology works. The testnet suggests it does. The really fascinating question now becomes, how quickly can a network with that kind of massive scale translate proven utility into widespread real-world adoption? How fast can it become the dominant financial layer for mobile users once that mainnet fully opens in Q4? It feels less like a technology challenge now and more like a massive adoption and execution challenge.
A very interesting point indeed. We'll have to see how it plays out until the next deep dive.